Hey trader, welcome back to MFS Trading. Today we'll delve into the topic of trading using a stochastic indicator. The stochastic indicator gauges market momentum and trend strength, providing valuable insights into price momentum just moments before a reversal. This timely information offers an excellent opportunity for entering or exiting the market, ultimately leading to potential profits. In this video, I'll guide you through efficient and professional trading techniques using this indicator, supplemented with practical examples to illustrate the trading strategy. So please stay with us until the end of this video. Before starting today's video, you can support us by using the links below the description, or you can also join Telegram to receive free daily signals. Let's get right into the video in this trading strategy. First, let's establish what a stochastic indicator is. Stochastic indicator reveals the relationship between the closing price of a stock and the high and low price range over a 14-day period. It measures the momentum and the trend strengths in the market. Momentum is like throwing a rock into the air. Initially, the speeds are very high, but as the rock ascends, its velocity gradually decreases. The same as momentum, the price momentum at the beginning is very high and wanted to go higher and higher, and as the price go up and the time pass by, you see the momentum of the price reduces, and it reduces until it comes to a stop. And then it reverses, and the price reverses just a moment after the price reverses and going down. Crucially, momentum always shifts direction before the price does. The stochastic indicator is expressed as a percentage ranging from 0 to 100 and is divided into two zones. The oversold zone falling between 0 and 20%, and the overbought zone spanning from 80 to 100. In the following section, I'll show you the process of calculating the stochastic value during an uptrend using 10 consecutive candles. Let's assume we have 10 candles in a row, all pointing in an upward direction. Now let's assume that the highest high value among the last 10 candles is 100 and the lowest low value within the same set of candles is 40. Additionally, the closing price of the most recent of these 10 candles is 90. To calculate the stochastic value, you'll subtract the lowest low from both the highest high and the last close price. In this case, the difference between the highest high and the lowest low is $60, while the difference between the last close price and the lowest low is $50. Calculating the stochastic is straightforward. You take the ratio of $50 over $60 and multiply it by 100, resulting in a value of 83.33. Since this value falls within the range of 80 to 100, it clearly resides in the overbought zone. The high stochastic value indicates that prices have shown considerable strength over the course of these 10 candles, suggesting that market conditions favor further upward movement. I'll also explain how to calculate the stochastic value during a downtrend using a sequence of 10 candles. Let's assume these 10 candles forming a downward trend. Here, the highest high among these 10 candles is $100. The lowest low is $40 and the last closing price is $50. When you subtract the lowest low from the highest high, you get $60. Likewise, subtracting the last close price from the lowest low yields $10. To compute the stochastic value, you simply take $10 divided by $60. And then multiply the result by 100, giving us a value of 16.67. Because this figure falls within the 0 to 20 range, it resides in the oversold zone. The low value of the stochastic indicator indicates that the closing price is only 16.67% above the low point of the range. Consequently, the momentum of the downtrend is very strong. This is the price trend on D1 time frame. I've added a stochastic indicator with a 14-day period. The overbought zone is marked with the rectangle blue color, while the oversold area is highlighted in red. These zones are delineated by the levels of 20% and 80%. The stochastic indicator comprises two curves. The fast-moving average indicated with blue color here, and the slow-moving average represented by the red line. When the blue curve is positioned above the red curve, it signifies an uptrend, while if the blue curve falls below the red curve, it indicates a downtrend. Many traders employ this technique for timing their market entries and exits. In the overbought zone, when the blue line crosses below the red line and dips beneath the 80 line, it triggers a sell signal. Conversely, in the oversold zone, If the blue line crosses above the red curve and rises above the 20 line, it generates a buy signal. It's essential to recognize that this is not a complete trading strategy. Rather, it serves as an entry trigger helping you get into a trade. The overbought area represents a zone where the uptrend's momentum is strong and shows potential for further upward movement. Regrettably, some traders make the mistake of going short as soon as the price enters the overbought zone. Prices can remain in the overbought zone for an extended period, steadily rising, leading to significant losses. There are times when the trend reverses, requiring a shift to a short position. The oversold area is a zone where the downtrend's momentum is substantial, indicating a willingness to move even lower. Regrettably, some traders make the mistake of going long as soon as the price enters the oversold area. Prices can linger in the oversold region for extended periods, potentially weeks or even months, continuing their descent and resulting in financial losses. However, there are instances when the trend begins to reverse, necessitating a long position. And now, how to trade with a stochastic indicator like a professional. Let's start by examining the price trend on the daily time frame. I've set up a 14-day stochastic indicator and a 100-day simple moving average. The chart clearly defines overbought and oversold areas with zones marked at 20 and 80. To initiate a trade, your first step is to determine the trend's direction on a longer time frame, such as the D1 time frame. It's crucial to align your trading strategy with the prevailing trend, not against it. As you can observe on the daily time frame, the trend is pointing downward. In this scenario, it's advisable to consider a short trade. To enter a sell trade, shift to a lower time frame. In this case, the 1-hour time frame. Here, apply your price action analysis, including patterns, formations, and candlestick patterns. Consider taking a short position immediately after a well-timed bearish reversal pattern right as the stochastic oscillator moves out of the overbought area. These are the optimal entry points for executing sell orders, representing a professional approach to trading. Once again, in this chart, I'm going to demonstrate how to trade with the stochastic indicator like a professional. This is the price trend on the D1 time frame. Just like the previous example. To initiate a trade, your first step is to determine the trend's direction on a longer time frame, such as the D1 time frame. The goal is to align your trading strategy with the prevailing trend rather than going against it. In this case, the trend is ascending on the D1 time frame, indicating a potential buy trade. In order to enter the market, you go one time frame lower, H1. So you go to H1 time frame and use your price action such as pattern formation and also candlestick pattern. And you see a sign of uptrend. Consider taking a long position immediately after a well-timed bullish reversal pattern right as the stochastic oscillator moves out of the oversold area. This represents the professional approach to using this indicator and ultimately leads to profitable outcomes. You can easily create your own combination of stochastic oscillator and SMA, as I explained. In summary of this video, here are the key steps to enhance your trading approach. First, employ the 100-day simple moving average to determine the trend direction on a longer time frame such as D1. Second, leverage the stochastic indicator to pinpoint overbought and oversold levels within the trend on the D1 time frame. Lastly, utilize candlestick and chart patterns or the stochastic indicator as entry triggers on a shorter time frame like H1. That concludes our discussion for today. Traders, if you enjoyed today's video, leave a like to it and subscribe to MFS Trading channel. Good luck for you.